Welcome back to Desi Return. In today's video, we are going to cover an important topic, especially if you're based out of US and you have been managing healthcare cost. We are talking about health savings account, which is also called HSA. In this video, I'm going to talk about what is HSA, how does it work, and how should one manage these funds when they're planning to move back to India. Let's dive into the details. First, a health savings account is a type of a savings account to help with your medical expenses. It's a tax savings account designed where you can put some money aside to cover your healthcare costs. However, there are some constraints in terms of eligibility, contribution limit, what these funds can be used, and some of the downsides if they are not used for that purpose. Let's get into the specifics here. First, eligibility. For someone to be eligible for HSA, they have to enroll in a high deductible health plan, which is also called HDHP. For 2024, the plan has to have a deductible of $1,600 at least for an individual coverage and $3,200 for a family to be considered as a high deductible health plan. Please keep a note about this requirement. If you are a healthy family that doesn't require much insurance or healthcare, then it makes sense to be enrolling in this high deductible health plan. If not, you have to meet this threshold before the insurance covers. So make sure this plan is appropriate for your healthcare needs. Second, you should not have any other health coverage like Medicare. Third, you can't be a dependent on someone else's tax returns. As long as you meet these three criteria, that you're enrolled in a high deductible health plan, no other health coverage, and you are not a dependent on someone else's tax returns, you are eligible to participate in the health savings account. Now, let's talk about the contribution limits. So in HSA, if you're enrolled under an individual plan for 2024, you can contribute up to $4,150. If you are under a family coverage, you can contribute up to $8,300 in 2024. Also note, if you're above 55 years and old, you can have a catch-up option where you can contribute an additional $1,000 on the top of these limits. So if a person who is will have a family coverage and who is above 55 years old, they can contribute up to $9,300 in 2024. Please note the contributions from your employer as well as yours, both combined would count towards the threshold or the contribution limits. For example, if your employer is contributing $100 every paycheck, which is on a bi-weekly paycheck, which means they would contribute $2,600 in a given year because there are 26 pay periods, which means you would have about up to $5,700 available that you can contribute from your side because the limit is $8,300 for someone who is having a family coverage. So this is a bit different than your 401k where the employer contribution doesn't count towards the maximum contribution you can do to a 401k. In HSA, both your contributions as well as employer contributions count towards the limits. Now let's talk about the advantages of HSA. The first important advantage is triple tax savings, or also called trifecta. What does that mean? So the contributions you are doing into a health savings account is tax deductible. So you won't pay taxes on the money that you are contributing towards a health savings account. This is the money coming from you, not from your employer. So if the money is coming from your paycheck, you also don't have to pay the additional 7.5 FICA taxes. You can deduct your contribution from your W-2 income. So there are tax savings from your contributions. Second, in terms of the triple tax savings, the money within the HSA can grow tax-free. So there are no taxes for the money that's grown within the HSA. Third, if the money is used for eligible medical expenses, you don't pay taxes on that. That's a third tax savings. So this is the triple tax savings plan. So what is covered under eligible medical expenses? We will have a link below on the items or what's covered as a medical eligible medical expenses. Also note there is like Amazon HSA store, which has the list of items that are covered under HSA. It's much more broader than what you think. So please check it out if you have HSA funds and see if some of those things that you need, maybe you can utilize your HSA funds to purchase them. The second other big advantage is if you have funds that you haven't used in a given year, that money would roll over to the next year. So it's not like lose it or use it like an flexible spending account, like an FSA. So if we haven't used the money, it would roll over to the next year and so on. So as long as you have HSA open, and if you have an eligible medical expense later in the life, you can use your contributions or the fund available in your HSA account. As an example, 20 years down the road, you have a surgery and you want to utilize the funds. It is completely eligible as long as that is an eligible medical expense. You can utilize the funds from your HSA to cover that. So now let's talk about the custodian that manages the HSA. Unlike 401k plan, where you can't roll over the funds from your custodian to another custodian as long as you're employee of that employer. In case of HSA, you can roll over these funds into another custodian. So it's not tied to your employment. That's the first thing that I want to make sure that you're aware of it. So if you have funds and you want to consolidate them, you are more than welcome to roll over to a different custodian. Second, the funds that you have in the HSA, you can invest in mutual funds or stocks. It just depends on your approach. If you want to be conservative or if you want to beat the inflation and invest, you can definitely have the flexibility to invest that in a mutual funds or a stock that are all provided by your HSA. However, there is a threshold. So as long as your funds are above $2,000 or $1,000, you can invest that money into mutual funds or stocks. That's another important aspect so that you can let the money grow tax-free. In terms of the downsides, HSA is not perfect. The main downside is if you don't use the funds for medical expenses, there is a 20% penalty if you withdraw these funds before 65 years old. And you also have to pay income tax on the top of it. So for a non-eligible medical expense, any withdrawal that you do before 65, there's a 20% penalty and also an income tax that you have to pay on the withdrawal amount. Second, if you withdraw after 65 for a non-medical expense, you don't have to pay penalty. You have to pay only the income tax. It becomes almost like a traditional IRA after age 65. However, if you use it for medical expense, there is no tax that you have to pay. There is no penalty. That's an important aspect. This is the taxation from a US perspective on the health savings account. I hope it gives a broad overview of the health savings account, what it is, the eligibility, the contribution limits, the advantages, as well as some of the downsides that you need to be aware of. Now let's talk about how you should manage the health savings account funds when you are planning to move back to India. First, can you utilize these funds for a medical expense in abroad is a common question. And the answer is yes. So you can utilize the funds from your health savings account for any eligible medical expense that you incur abroad, whether it's in India, and you can, as long as that medical expense is covered in US, this is eligible. However, please note to make a good records of these expenses, receipts, as well as the exchange, because you have to report and document the medical expenses in the US dollars. Also, check with your custodian if the debit card that they provide would work abroad how much is the transaction fee, which is a foreign transaction fee, or you would pay out of the pocket and then you get it reimbursed. Please have these discussions with your custodian. And another important aspect with the health savings account is the record keeping. You have to keep the good records of the medical expenses so that if there is any audit, they can always verify this is an eligible medical expense. Now, let's talk about the second topic, which is the taxation. The health savings account is not considered the same tax advantage account from an Indian tax law perspective. So in India, there are three different residential status from a tax perspective. We have covered details on this topic in our video mentioned on the top here. So when an individual is in a non-resident or an R&OR, there is no income tax, there is no reporting that someone has to do for a health savings account. However, when they become a resident, they have to report their accounts abroad. In this case, a health savings account, they have to report. Even if they are not utilizing the funds, they have to report. And also the eligible expenses, even if the withdrawal is for medical expense, that is still considered as an income and you have to pay tax in India. Whether it's an eligible medical expense or not, you have to pay tax for dividends, realized gains, and so on. So keep that in mind, especially when you're utilizing the HSA funds in how those would be handled in the Indian taxation system. And I think we kind of covered that. I think the third important one is reporting of these accounts, the funds, even if you're not utilizing it when you are a non-resident. So these are three important things that you need to be aware from an Indian taxation perspective. Now, let's talk about how should one consider on managing or handling about these HSA funds. First, if you're an US citizen and you have to file the taxes irrespective of the residency. Like, even when you're in India, even if you don't have any income from US, you still have to report your global income on the US side. So from a tax returns filing, I think you need to do that. And if you have any plans to move back to US or you will be there, keep in mind, I think, as long as these funds are utilized for medical expenses, there is no penalty and tax-free. So I would say, I think, it's an option. If you have plans to be back there, you can leave, because especially as you get older, the healthcare costs are going to be much higher and you can utilize it at the time of, as you get older. The second, if you are a non-resident, and what should you do with your funds if you're a non-US citizen and you become a non-resident in India? So here are my insights or my opinion on that. If you have, the funds in HSA, which is very minimal, try to withdraw them, for an eligible medical expense if possible. Check out the Amazon HSA store and anything like that. If not, it might make sense to take the 20% penalty and you pay the income tax. Maybe the income tax while you're an R&R phase is minimal in US, because there is no income in US, and you might pay the tax and get it done with it. So you don't have to report and you don't have to file taxes every year in India, which could be complex. If you have enough funds, you can try to do some tax planning in R&R where you can withdraw some funds, or you can let the money be in the HSA until age 65, and then try to withdraw when your global income, including the income in India, is lower and you pay the taxes. But I just want to provide these options and how the India treats these, funds, the taxes here in related to the HSA. And depending on your situation, choose which one would work. And I hope this video is helpful. If you like the content, please feel free to share your comments and feedbacks. And don't forget to subscribe, as we provide more valuable content to make your decision as well as journey back to India smooth and successful.